So this week's topic is crash buying because we know that market there's a bit of deep, I won't call it corrections or crash. Actually, this is really just clickbait. Mainly to just look at the market, what happened in the past 2 weeks, and then just try to explain what am I doing. S&P 500 dropped by 8.3% from 52 weeks high or from all-time high. So you can see that 8.3% is not like super big, but you can see that later I'll show individuals, companies, I think they drop a bit more. So if you look at the QQQ, which is quite close to my portfolio, right? It's down 11.3% from 52 weeks high. And then if you look at the individual companies, you can see, they have quite a more significant dip now. So Microsoft, I think this one is not like just the recent one. Actually, if you compare, I think they peaked around mid of last year. So from 52 weeks high already dropped by 17%. Then Apple already dropped by close to 18%. Amazon dropped by 18.4%. Google dropped by 19.7%. Nvidia dropped by 20.5%. I think 20.5% is because there's a bit of rally in the past few days. If you count until, let's say, 3 days ago when it bottomed last week, right? I think the drop is more significant. For TSMC, dropped 23.1%. This one, when it reached 224, I thought that it would continue to go up because from valuation perspective, it still looks quite reasonable. But after that, it just continued to dip now. So this is really, I didn't expect this to happen. Right now it's at $174. Quite a good buy level, I think, for TSMC. Then I think the largest drop is definitely Tesla, down almost 50% from late December 2024. So this one, I think there's a lot of news. I think this episode won't cover the details, but just the headline numbers, right? You know, all these things about Elon and then Doge and then all the vandalisms happening. So there's a lot of things happening with Tesla. On one hand, the fundamentals looks concerning, especially when we talk about the Q1 growth numbers, their delivery numbers, all those things. Drop in European sales, I think that's quite concerning. On the other hand, you see that they say they're going to launch the unsupervised FSD in June. So that's quite promising. So it's very stark contrast between the two sides of developments. But right now, down 48.8%, I think this is quite a significant dip since 52 weeks high. Okay. If we look at the markets, right, you see that now the fear and greed index is already at 21. I think they bottom roughly the previous close, right? I think that was Thursday, was at 14. So, I mean, not too long ago, right? You look at just 1 year ago, it is at 70, right? So, market can swing up and down. In terms of the fear, right, you can see that recently there's quite a significant drop now. So, if you look at the time series, right now we are at 21, right? Yeah, 21. So, when was the last time it was as low as 21? You need to go back to around mid of last year. So since mid of last year, right, second half of 2024, right, market have this rally, right? And then the fear and greed index hovering around, fluctuating between 50 and 75, right? That's the range, right? So that's why I say it has been quite some times that I slow down my deployment in investment so that I keep some cash buffer. And also the market looks quite expensive, right? So I don't want to fully deploy. It's mainly to save some buffer to be deployed when market is at more attractive level. So I think now you see that market, in terms of the fear and greed index drop to 21, I start to really get a bit excited because of the opportunities. I wouldn't say that now it's like a bottom or what. It's very hard to call the bottoms. I'm not Mr. Lu. But whenever you see that, okay, but market just, they penalize all companies, everything red, and then you can see that this index drop below, let's say 20, right? Definitely you can feel the fear in the market, right? I think those are usually a better time to enter. You want to be a contrarian, right? So I think that's quite interesting. This is one of the indicators that I'm looking at. But remember, this is not like a fundamentals metrics. This is just a sentiment metrics. But we will get into more details to talk about what are they covering when we talk about fear and greed index. And specifically, this is by CNN methodology. I think if you look at different methodology, of course, they have different weighting, different way of calculates. But I think broadly speaking, they are all looking at similar things. Now, we look at the details, right? Because we'll go through a few of these indicators to see what do they mean by, fear and greed index. So if we break down, right, the first one that they look at is market momentum. So basically, they are comparing the S&P 500 index level versus the 125 days moving average. And this 125 days is trading days. So I think 1 year, roughly, there's about 250 trading days. So if you look at 125, it is roughly about 6 months. So they look at half year average, and then just compare it and see whether we are above that or below. Because if you are above this moving average, right, what it means is that the momentum is positive. When momentum is positive, usually the likelihood is that it will continue to push higher. And let's say if the momentum is negative, right, the likelihood is higher that it will come down. Right? That's at least based on the momentum indicators. But you know that all this market area is not like based on one indicators. Momentum is only one of many indicators, and it is quite a useful one. It's just that it's one of many. And the other thing is that when we talk about all these things, right, it is more like a probabilistic measure. Don't take this as something that is like, you say yes, then it's 100%. There's nothing 100%. We are just talking about like positive momentum, likelihood it will continue to go higher. And right now, the momentum I think is come to negative. So chances is it will continue to come down. Okay, at least that's momentum. That's why it is labeled as extreme fear here. Second one is stock price strength. So this one, they call it like net new 52 weeks high and low on the NYSE. This is not just like looking at the index level, because index level, right, mostly they are influenced by all the largest market cap companies, right? But this one is really looking at how many stocks are doing well versus those that are struggling. So they take the ratio. And right now, the ratio, this level, right, this index level is below 0%. What it means is that there's more companies that is dropping to 52 weeks low as compared to those that is at 52 weeks high. So again, this is labeled as extreme fear. The next one is stock price breadth. So this is, let me read it out for you. The market is made up of 1,000 stocks, and on any given days, investors are actively buying and selling them. This measures looks at the amount or volume of shares on the NYSE that are rising compared to those number of shares that are falling. A low or even negative number is a bearish sign. So what this says is that there's more companies that drop as compared to companies that went up in price. And I think this is similar to the 125 days momentum or moving average comparison. It's just that now this one is giving more weights to those companies that are smaller in market cap, because they are counting number of companies and not counting by market cap, right? If by market cap, they mostly influenced by the mega cap. This one is looking at overall markets. So it's by count. So you can see that it's also quite low now. You see it peaked around October last year, and right now it's quite low numbers. So it's also extreme fear. And then the next one is put and call options. I think this is also quite a popular one. Basically, it is looking at the price of the put options versus those at the call options. So what it means is, let's say if this number is high, right, that means there's more people buying put options. They're buying insurance because they think that market will drop. So they buy put options more than the call options, right? Whereas let's say if this index level is low, there are more people who are bullish and they are buying into call options, right? So right now we can see that it's already quite high at close to like just above 0.8. I think this ratio just signals that market is really, you can feel the fear. So it's at extreme fear level based on these definitions. Then the other one is market volatility. This is quite simple because all these options, right, whether it is priced at high premium or low premium, that is really depends on the volatility numbers, right? If the market is very volatile, so the VIX is high, right? So all these options prices are high and vice versa. And if we look at this number right now, is definitely higher than the 50 days moving average. What it means is that currently market is pricing in a high volatility, and high volatility is always associated with fear sentiments, right? And this one quite interesting. They are labeled this as neutral. I think mostly because it came down recently. But if you just go back to, let's say, like 1 week ago, right, I'm sure that it's like, close to 25 or 30 level. That's quite high level. But of course, this one can be swinged by a lot of things. Say, for example, I think last year when we talked about all these Japanese yen carry trade unwind, those kind of things, when there's all this incident, right, VIX can spike within short period of time and then come down later, right? Recently, I think it hasn't even exceed 30 levels. So it's by this measure, it's not like super high, but it is definitely elevated because during low VIX level, right, it could be as low as 15 or even single digit, So that's VIX level. So it's currently at neutral here. And then the next one is difference in 20-day stocks and bond returns. This is really quite simple. It's just comparing the returns on bonds versus the returns on stocks. So if it is high, as shown as in this chart, right, that means stocks is outperforming bonds, and if it is low, bonds has been outperforming stocks. So you can see that recently it's already down 10%, right? And this is really just looking at past 20 trading days. So it's very short horizon. So it's really down by 10% because of recent weakness in stock market, right? So that's why considered extreme fear. So I think this one, maybe you can say that it's similar to the RSI index, basically looking at short-term performance. And of course, when you are comparing against bonds, right, what it means is that, let's say really there's a lot of money, people sell on stock market and then they buy bonds, right? And then bond price shoot up. That means bond yield come down, right? And that's a good signs of de-risking, right? Because whenever people sell stocks, right, the money, it will go somewhere. Usually the destination is going to bonds. So there's some money that swing between bonds and equities, right? And this one is really just to measure the movement in the past 20 trading days. 20 trading days, by the way, is about 1 month. It's also like extreme fear. The next one is junk bond demand. So this is the yield spread, right? Yield spread, usually when you see this word spread, right, what it means is that it is a comparison between two numbers. And specifically here, we are looking at the junk bond, meaning those non-investment grade, right? So we're talking about, like, let's say double B, single B, triple C rated bonds, right? What is their spread? Spread is basically the premium. So this is the yield that the investor earns over the risk-free rate. They are comparing this spread level versus the investment grade. So usually when this yield spread is high, right, that means investors are demanding a lot higher returns for taking on more risk, and specifically it is the corporate bond risk. So when it is high, that means there's a fear sentiment. But right now, if you look at these metrics, right, it's currently still considered very low. I think what it means is that the markets, although there's some volatility in the stock market, but generally speaking, the markets doesn't believe that there will be a lot of bankruptcy that's upcoming. Because let's say if market become jittery and then let's say growth slow down, and for whatever reasons, market believes that the weak companies, right, those with high debt, low credit ratings, they believe that those companies may not survive the current downturn, right? So their bond usually will be traded at very, very low price. Or what in other words is that the credit spread for all these junk bonds, right, will be very high. So I think that's basically is like a metrics of thinking how many of them might actually bankrupt. But let's say if we just look at this, right, the number is still low. What it means is that market don't believe they will go bankrupt. It's just market volatility without affecting the chance of survival. That's my interpretation on this. But anyway, if you just look at these metrics, whenever it go up, right, what it means is just that, okay, market de-risk, market is in fear mode. It's just, one of many metrics. Okay, so we just went through, like, the underlying breakdown of all this fear and greed index, right? And it's quite clear, although one is showing greed, okay, I think one is showing neutral, but the rest are all showing extreme fear, right? So now it is quite clear, right, that the market is in fear mode, like now, as of now, right? I mean, of course, it can change. Let's say if 1 month or even 2 weeks later, this pendulum might swing again, right? But as of now, like as of last week, it is quite clear that market is in fear mode. I think that one, I think everyone can observe. The questions that I want to ask you is that, what have you been doing over the past 1 week? Do you buy or do you run away? Because you remember, I think there's one message that I share in the Telegram group is that people are commenting on my past videos, say that, oh, let's run for cover, market is dropping, So that's, you can see that whatever happens, right, it could be market rally, it could be market down, it could be some positive news, could be some negative news. You see the reactions from people are always very different. We are all different people, different opinions. That's quite normal. It's just that I will just point to you that usually during market fear, right, you will see very stark difference between two group of people. There's one group of people who will just, oh, I'm running away, I'm just sell and then just protect my capital for now. And then the other group is that when they look at all these markets in fear mode, right, they are getting more excited. They are pay more attention to the market and look for opportunities, because during market rally, sometimes the valuations can become quite high, and that you are buying at those level, right, you are not getting a good deal. But during market fear, right, that's when potentially you can get some good, like, attractive opportunities around. I'm not saying that current level you buy now is like super good opportunity. That's not my point. My point is that when talking about your actions, right, do you really run away when you see these kind of things? I think that one will actually determine whether over the long run, right, will you be successful in your investing or not. I think that's one thing that separate those who are strong enough to hold and act during this kind of fear versus those who are just panic or paralyzed or just protect capital and just run away. I know that for those who are trading, usually they set some sort of like stop loss, and if you follow your trading strategy, you stop loss and then you say you are trading, I think that's fine, right? I'm not covering trading here, although some of those index that we are looking at 20 days, those are really like trading kind of indicators, right? I'm just thinking that, let's say if you see yourself as someone who is investing and you are buying most of the time because you are still saving, you have all this capital to deploy, right? During this kind of fear moment, are you excited to buy, or are you start to feel panic or want to stay away? So that's why I really leave it to you just to think about that. I think that's it's not something that we can say, oh, you just follow this and this, then, because it's not as simple as that. It's more like a mindset kind of things. So that's something I wanted to share there. As usual, I mean, my portfolio, if we just look at year-to-date numbers, is down 12.46%, slightly worse compared to QQQ. I think that's also because Chinese stock has been rallying year-to-date, right? I think that one helped my portfolio a bit more. But over the US market, I think my portfolio are those closer to, like the Magnificent Seven, right? And those really drop between, let's say, like 18 to 22%, right? So usually my market has higher beta, meaning that whenever market drop, it will drop more. Whenever market up, my portfolio also up a bit more. So that's it's more volatile as compared to just S&P 500. So down 12.5%. This one is just to show you guys that, whatever numbers that I have, right? Those are, I didn't make up all those numbers. When it's green, I show the green. When it's red, I show the red, right? So this is really for transparency. And if you look at my portfolio trajectory, right, I track this regularly. I look at my portfolio, because when market drop, like, wow, if I count the dollars amount that I lost, right, it really quite big numbers. And sometimes I also like, a bit sian, look at the market, wow, my portfolio down so much. But if I look at this table, which I prepared for myself, right, I mean, this one means that I need to zoom out and look at the trajectory of my portfolio, right? I mean, if you zoom out, the whole thing continues to go up. Even I tracked the S&P 500 since I started invested in this portfolio, right? S&P 500 also go up. Of course, it is not one straight line up, because you can see that, let's say, during COVID period, market drop and my portfolio also dropped. But you don't see that because I've been putting a lot of money in, right? So you don't see that. During 2022 period, market down for a year, right? You see my portfolio, even though I keep on putting money in, still down. So you see there's a drawdown there, right? Then after that, from 2023 to 2024, market rally, my portfolio also up. And now we have a dip here in March 2025, right? So to me, these are all just, market fluctuation, normal volatility. Like I said, the thing is, you look at all these things, if you believe that the companies that you invest in are good companies, quality companies, their fundamentals remain good, there's nothing to worry, okay? So that's why I would say what I'm doing here is just like looking at this. If I can't know that market will go up, but I will know that I will continue to add into the positions, and hopefully by adding and then market recovery sometime in the futures, right, and my portfolio will be at all-time high again. So that's basically summarize my plan now, okay? So that's the portfolio part. Then like I said, you need to know your portfolio holdings, right? Those companies are good companies, because let's say if it is weak companies, right, you really don't know. They can go down and down and down, right? But let's say if the fundamental remains strong, right, then you don't have to worry so much about the stock price fluctuations. So this is just an update on my current portfolio allocations. You can see that it's still very heavy weight to those tech companies, say for example like Nvidia, TSMC, Amazon, Microsoft, Tesla, Apple, Tencent. Even the ETF, right, the one that's largest is IUIT, which is companies that focus on technology sector. Then Google. So this is my current portfolio. When I look at all these companies, right, here I'm just referring to just one indicators, because I don't want to, like too much information and then you don't have, it's hard to have a takeaway, right? Here I've just focused on one indicators, which is the earning before interest and tax. So this is the EBIT number, and this is a last 12 months measure, but because I don't want, sometimes if you look at quarterly numbers, it can swing because of the seasonal things, right? So if you just look at the last 12 months, it is a rolling numbers. So you can just focus on these numbers, right? The companies that I have been investing, their earnings are going up over time. You see Apple going up. Although the pace is not as high as compared to the other companies, say for example like Nvidia or Amazon, right? But still slowly going up over time, right? Microsoft also, you see the lines like keep on going up over time. Nvidia is like really like, since the bottom in early 2023, right? Just skyrocket. Amazon's also a great turnaround, just go up. TSMC also up. Tencent, China companies has been rallying recently, all going up, right? The only one that is like a bit concerning, at least from fundamental perspective, is really Tesla. But like I said, Tesla, if you look at fundamentals numbers, right, I mentioned in the past before, it looks ugly. I think even as an investor, right, when it is ugly, I don't want to say it looks good, right? It is really ugly. Numbers are down. Even if you look at growth numbers, there isn't much growth number. Even if you look at analysts forward estimate, right, they are talking about like, single digits kind of growth number. At least over the short term, for Tesla, fundamentals numbers doesn't look good. The part that's a bit more promising or something that I myself want to bet on is really the unsupervised FSD that the company want to roll out in June this year. Even if there's some delay, I think by this year they will have something roll out, and then by over the next 2 to 3 years, maybe I actually believe that there will be a re-rating of the companies as this company transform into FSD companies, right? So that's my expectations. So I think that part is more promising compared to all these their earnings, revenue numbers. But the other companies like Nvidia, Amazon, you look at their numbers, all looks good. You need to remember all these numbers, right? It's not like forever it looks good one, because just look at 2022 when the market was down, my portfolio was down. You look at their numbers are also down. Even Nvidia also down quite a fair bit in 2022, right? Amazon was also very ugly back then. But as long as the company's fundamentals remain strong, by fundamentals I mean their business mode, their management, all these long-term things, right? They don't turn into a companies that go to shits, basically. As long as they are doing well, right? Even there's some downturn in terms of their earnings number, you can still reasonably expect that they will go up over time, right? Over a long period of time. So at least that's my belief. And you can see that all this going up, right? It will affect the stock price, and it will, it will bring the stock price up, and it will bring my portfolio up as well. So same for you. You should look at your portfolio, look at their fundamentals, ask yourself, what's going on with their business? Is the business going well, or is the business struggling? Are their current fundamentals looks good, or is it bad? If it is good or bad now, do you expect it continue to do good in the futures, or do you expect that it will continue to do better, or you expect that it will go down? So those are the questions that you need to ask yourself, and be more focused on the fundamentals, the company, the business, rather than just the stock price. Because you know that all these stock price always swing up and down, and our emotions always affected, right? But fundamentally, we are not betting on the price to go up, right? We are betting on their fundamentals, the business. That's most important. So that's my message here. So the takeaway, fundamentals remain strong. I'm not worried. So that's my takeaway. Even though share price can come down, definitely, but that's my view. And then let's quickly also cover the valuations, because I know that whenever people see that the stock price down, market is in fear, you just want to buy, right? But just remember that even at current level, the valuations, right, by forward PE, right, for S&P 500, I'm not talking about the other market, just US market, right now is at about 20x forward PE. Yes, it is definitely cheaper as compared to 22x, which was not too long ago, but it is still not super cheap level. It is not at depressed level. It just came down from a high level. So if you are to add, right, I would say that don't think that this is the bottom now, because always whenever it dip 10%, right, it can always dip another 5 or 10%. But you can also just hold on all your cash and wait for another that 5%, because timing the bottom is very, very difficult. So what you want to do is that whenever the price drop to a level that you feel reasonably good enough, you need to add a bit already, add in tranches. At least that's my approach, so that you know that if there's a rebound and the market just go like higher and longer, right, then at least you already bought some. So I think the buy in tranches, that's the way. So just, the takeaway, right, valuation has come down slightly. It is not at depressed level. I suggest buying in tranches. Okay, that's the key takeaway. And then roughly, let's look at the recent markets, right? Because you remember, let's say Friday market, Thursday was down quite a fair bit, right? Then Friday rebound. And then if you look at that rebound, it's really, I think, because of the inflation numbers looks good, because US inflation right now is 2.8%. I think this is lower than the market expectations. That's why market has a bit of rally. So definitely that's a good picture to see. Then let's look at the Federal Reserve expectations, right? The upcoming meeting is 19th of March, which is like, I think, 3 or 4 days from now. For this next week, Fed meetings and the meetings after that, right, likely there won't be a lot of changes in terms of their interest rate level. Right now it's at 425 basis point to 450 basis point. I think generally speaking, market is still expecting the Fed fund rates to gradually come down. I think partly also because right now, if you look at the inflation number, it's about like close to 3%, right? But Fed fund rate is slightly above 4%. So there's still this gap between the Fed fund rates versus the inflation rate. As long as inflation stay below, let's say 3%, right, I think over time this number will come down. The reason it doesn't come down straight away is because I think generally speaking, when Federal Reserve looking at all this market data, right? It's not like just one number they're looking at. They're looking at many numbers. And then even, let's say, all this talk about tariff, because tariff might spur inflations, right? I think that's also something that market is concerned, and market is, pricing in some inflations in the future. So I think that's also why there's some, they keep the Fed fund rates higher than inflation rate. So because this inflation thing is not like something that is already confirmed over. We don't know yet, right? So it's just a bit of buffer to make sure that inflation stay low and don't spike up again. Because let's say if inflation spike up again, right? Inflation feed inflation. So I think that's the risk when we talk about inflation. That's why you need some buffer there to make sure that they stay low. But if you look at the recent, this is the consumer sentiment survey, right, on the expected inflations. The 1 year expected inflations, right, is just recently jumped up to about 4.9%. So I think this one maybe has something to do with the expectation of upcoming tariff. That's why this is something that the market is worried about, whether inflation will come back or not, right? So that's why I think all Fed fund rate is at this level looks reasonable. What it means is that if you expect that there will be a very quick Fed fund rates drop to rally the markets, right, I think you need to tone down that expectations. I think we will probably stuck with current level at least for the first half of 2025. So that's the market indicators. Usually when I look at the macro numbers, right, there are so many macro numbers. Usually the one that I'm looking at is the inflations, and the other one is any indicators that points towards whether there's slowdown in growth. So unemployment could be one, PMI could be the other one. But right now, I think growth numbers still, I think it came down slightly, but still not at the level that point towards recessions. At least that's my feel. But since we have this inflation number print, right, I just mentioned here. Okay, I think that's all about my sharing this week. From F. Lim, what level would you add? So I think when it comes to the level, right, I don't have like, specific level to say that, I'm waiting for this level, then hit this level, I will buy, right? It's not like that. My approach is always to make sure that I will buy, and then I will try to keep the pace at certain level. So say for example, right, let's say last year when market valuations was quite high, right? Actually, I slow down my buy at least for this US markets, right? I really slow down and keep some cash, and then some money has been deployed to, let's say, like Singapore markets, right? Or REITs, right? So I've deployed some into those market. But let's say come to US market, right? Since the market is at more attractive level, then I'll go back and start to buy US market again. It's just that it is not like one off kind of purchase. It's more like every month gradually buy, those kind of approach. Then of course, let's say if market suddenly just rally and back, then I might slow down or pause my buy for US markets. At least that's my approach, because I know that it's very difficult to time the bottom. So sometimes usually I need to pace the buy with my, let's say, my salary, right? Salary in, I know that I have some money to deploy, right? Then I'll start to deploy stuff. So like at this level, right, I'm comfortable to gradually deploy. Nothing like, like big purchases. It's more like gradual buy. So that's my approach. See you all next week. Bye-bye.